Hello, my dear students. I welcome you all to Shri Jayendra Rank Zone. I'm your mentor for the subject Principles and Practices of Accounting. Today, we will start with Accounting Chapter 2. The name of this chapter is Accounting Process. This chapter is basically bifurcated into 6 parts. The first unit talks about the journal entries. Then we'll move to ledger postings, trial balance, subsidiary books, cash book, and at last, rectification of error. So today, we are going to begin with chapter number 1, that is basic accounting procedures, journal entries. Let me introduce this topic with you and let me guide you what is a double entry system of accounting. So double entry system of accounting is around 5 years old system. Basically, it is a system of bookkeeping where every entry of an account requires a corresponding opposite entry to a different account. So every debit entry has a corresponding credit effect. It is bifurcated between two sides, that is right hand side and left hand side. So right hand side and left hand side. The right hand side of the entry is known as credit and the left hand side of the entry is known as debit. We make double entry books accounts with the help of T-shaped accounts. I'll be showing you a T-shaped accounts as an illustrations in the coming pages. Okay, what we basically record? So we record all incomes, we record all expenses, we record all assets, we record all liabilities and capital. So any transaction which is financial in nature must find place in the books of accounts. Let's move to point number 1. Basically, this point talks about the meaning of account. So as I just told you, under the double entry system, that is the dual aspect, we have a debit effect and a credit effect. Assets are shown, liabilities are shown, incomes are shown, expenses are shown, and even the capital are shown. Assets, liability, expenses, losses, gains, capital. Generally, we prepare accounts for an accounting year. And accounting year is of 1 year. We have calendar year that starts from 1st of January to any year, supposingly 2020, and it will end 31st December 2020. One more popular year is financial year. So it starts from 1st of April 2020 to 31st of March 2020. The year 2020 is just indicative. Let's see a model format of an account. So as I told you, this is an account. So supposingly this is the account, but this is a which account? Cash account. Supposingly this is a cash account. On left hand side, we will record debit. On right hand side, we will record credit entries. The opening balance of cash account is obviously debit because it is an asset. All the transactions, so basically cash coming in the business, These transactions will be recorded on the debit side, and cash going out. These transactions will be recorded on the credit side. At last, we will calculate the total of debit side and credit side. So supposingly the total of debit side is 20,000. This total would be transferred over here, 20,000. The total of credit side is 15,000 in total. So 20,000 minus 15,000 will comes to the balancing figure, that is the closing balance. Balancing figure. And this closing balance is 5,000 rupees. I believe it makes sense to all of you. Let's move ahead with our another topic, and that is approaches to accounting. So basically there are two approaches to accounting. There are two methods. One is a modern method, another is a traditional method. So this accounting equation approach is also known as modern approach. And we have traditional approach. In case of modern approach, how we record books of accounts? So we basically record books of accounts through accounting equation. Now you should understand what is an accounting equation. It's very simple. So I am writing over here an accounting equation, that is assets equal to liabilities plus equity, that is capital. You can also write this formula as liabilities equal to assets minus equity, that is capital. You can also write this formula as equity equal to assets minus liabilities. I believe all of you must have understood the term accounting equation approach. This term is also known as modern approach of accounting. Let's go to a different approach, that is traditional approach. So the traditional approach follows golden rule of accounting. All the transactions are basically bifurcated into three parts. The first is personal account. Then we have a real account. And at last we have nominal account. Let's see accounting equation approach in detail now. The basics of accounting equation approach. So the transaction are to be recorded on the debit side, that is the left side, and credit side, that is the right side, depends on the nature of item for which the account is prepared. What kind of transactions we will record over here? So we will record an asset, we will record a liability, we will record expenses, we will record incomes, and we will record capital, that is equity. Students, over here I must tell you that supposingly during the year the company had made a profit. That means what? Profit is to be added to capital. Profit is to be added to capital or equity. I believe I am making sense to you. Let's see the rules of debiting and crediting the various entries in an accounting equation. The first is assets. Whether you will be debiting the asset or you will be crediting the asset. You should understand one thing over here, then all the assets have debit balance. Nature of assets. What is the nature of assets? Debit. In that case, you should understand over here, the asset will be debited when it will increase, and asset will be credited when it will decrease. So over here, when asset will be debited, all the transactions which increase the assets. What kind of assets? We have non-current assets, which is also known as fixed assets. We have current assets. We have investments, and so on. Stocks, that is inventory. When the assets are to be credited, so it's very simple. When there is a fall in the assets or there is a decrease in the assets, in that case the assets need to be credited. So supposingly, I'll quote an example over here. Supposingly there is a sale of fixed assets, or there is a sale of investments, or there is a sale of inventory. In these cases basically the assets need to be credited. I believe it is clear to all of you. Shall we move ahead? Okay, so let's begin with the second point, that is B, liabilities. So if I talk about the nature of liabilities, my dear students, the nature of liability is credit. That means what? That when the liability increases, when there is an increase in liability, it should be credited. And when there is a decrease in liability, it should be debited. So over here, if we want to debit the liabilities, transactions which decrease the liabilities, transaction would decrease the liabilities. Supposingly we had repaid the loan, a prepayment of loan, payment of outstanding salaries, payment of outstanding salaries, or outstanding rent. These things you must pay, and you paid it. Because you paid it, so now you don't have this liability to pay it again. So there is a decrease in liability and it should be debited. Let's see when the liabilities needs to be credited. So it's the personal nature of liabilities. That means what? That means when the liabilities, when there is an increase in the value of liabilities, in that case all the liabilities needs to be credited. When there would be an increase in the liabilities, supposingly the company has taken a fresh loan, taken a credit or overdraft facility from the banker. So all transactions which increase the balance of liabilities, like purchase of goods on credit, taking fresh loans, overdraft facility, or any other loan, short-term loan, medium-term loan, long-term loan, these are the cases the liabilities are to be credited because there is a considerable increase in the liabilities. I believe I'm making sense to all of you. Let us move to point number C, and that talks about equity or capital. Dear students, equity and capital has the same nature as of liabilities. That means what? It has credit balance. Whenever the equity or capital will increase, it is to be credited, and when there is a decrease, it is to be debited. So over here, the first column talks about debit. That means what? The equity or liability, there is a considerable decrease. So supposingly the owner or the proprietor or the partner has withdrawn the capital. Can I write it as drawings of capital? So they had withdrawn the capital from the business. In that case, the equity should be debited. Why? Because there is a considerable decrease, and vice versa, obviously. So if there is a considerable increase, if there is an increase in the equity or capital, it is to be credited. Why? Because it is the nature of the liabilities. So can I write additional capital? Additional capital bought by the owner in the business. Introduction of fresh capital, and over here withdrawal or drawings of capital. Have you understood, everyone? Let's move to point number D, and that talks about incomes. So it's a nominal account rule. So income falls under nominal account. We haven't gone through the golden rule of accounts right now, but I'm just teaching you the nature of income and nature of expense. So nature of income is credit. The nature of income is credit. That means what? That we need to credit the income account when it will increase. So see over here, transactions which increase the income, that is sale of goods, interest, rent received, dividend received, discount earned, that means discount received. These all are incomes in the business. Commission received. So it is to be credited. Over here, if there is a considerable decrease in the incomes, like sales return or discount allowed while making sales, interest paid, commission paid, so what we need to do, how we account them, these things need to be debited in the books of accounts. Why? It is the nature of income. Then if there is a decrease in income, it is to be debited. Okay, let's move to point number E, that talks about expenses. So the nature of expense is debit. That means what? If there is a considerable increase in the expenses, there this needs to be debited. And if there is a decrease in the expenses, it is to be credited. So transactions which increase the expenses, like paying salary, paying rent, paying interest, and other expenses, paying commission, paying brokerage, payment of brokerage, these things will increase the value of expenses, and so it is to be debited. The expenses to be debited. Why? Because the nature of expenses debit, and vice versa. Transaction which decrease the expenses, like reimbursement of the expenditure by way of grant. So in these cases, the expenses needs to be decreased, and so it is to be credited. Over here, the increased part, it is to be debited. Is it clear to all of you? I believe it is clear to all of you. What we are going to do right now is, I am going to write a short summary of the above table. That means what we have learned till now. So, increase in equity, that is capital, or increase in liabilities, or increase in income represent what? Represent credit. While decrease in equity, liability, or income are debited. I believe you must have understood till here. The next one is increase in assets or increase in expenses represent what? Represent debit balance or represent debit. While decrease in assets or expenses are to be credited. So we have learned 3 points till over here. Students, let's see point number 4, and that talks about examples of accounting using accounting equations approach. I believe all of you must have understood the accounting equation approach, that is assets equal to liabilities plus capital. It is also known as equity. So just see it over here. Mr. X has the following transaction. Show how the following transactions are to be shown under the cash account. It is very crucial. Cash account. How we will record it into the cash account. What impact on cash needs to be recorded. So just see it over here. A. The cash introduced into the business by Mr. X, 1 lakh. That means Mr. X has brought 1 lakh cash to the business. What would be the impact on cash? See, cash is an asset and all assets have debit balance. So over here, the nature is debit and there is an increase in the cash. So increase, cash comes in the business. Let's see point number 2 that talks about cash purchases made for $10,000. The company had made cash purchases. That means what? Some inventory the company had purchased and they had paid the cash. They had paid the cash. So whenever you will pay the cash, there would be a decrease. There would be a considerable decrease in the cash. And obviously, if there is a decrease in the cash, and cash is an asset which is having a debit balance, but over here, because there is a decrease, it is a credit side. Let's see this C point, that cash purchases made for $12,000. Again, Mr. X has made cash purchases. In that case, what will happen? So in that case, if you could just see, Mr. X had made credit purchases and not cash purchases. If you made credit purchases, there is no impact. Basically, there is no impact on cash will come over here. Let's move to point number D, cash paid. You had paid the cash, so there would be a decrease in cash and the balance would be credit. E point, cash sales. That means what? They had sold the goods and they had got the cash. So because they had received the cash, the journal entry would be cash account debit to sales account. So cash is coming in, sales is going out. Cash is coming in because, so there is an increase in the cash from the customer and it is debit side. Let's see credit sales. You had sold on credit basis, so there is no use of cash. No impact on cash will come over here. Not applicable. Let's move ahead to point number G, and that talks about cash received from debtor. Our debtor has given us cash. The entry would be cash account debit to debtor's account. Debtors would be credit. So whatever be the entry, over here the entry is 7,000 rupees. So cash comes in, there is an increase in the cash and cash is an asset, so it is a debit balance. Point number H, expenses paid in cash, that is 5,000. So you paid the expenses. That means what? Expenses would be debited because it is an expense and to cash. The amount would be 5,000. So expenses to cash 5,000. There is a decrease in the cash because you paid cash. And because cash is an asset, its nature is debit. Over here there is a decrease in the cash, so it would be credited. I believe all of you must have understood till here. Let's move ahead to our next topic, and that talks about nature of balance in each nature of account. So nature of balance in each nature of account. Just see it over here. An account may have one of the following balances. Obviously, either it have debit balance or the account will have credit balance or there would be a nil balance. So only one type of balance is possible at a time, obviously. So when an account is having debit balance, so write along with me, total of debit side is greater than total of credit side. So if the total of debit side is greater than total of credit side, the account is said to have debit balance. When the account will have credit balance, note down, when the total of credit side is greater than total of debit side, it is said to have credit balance. Why? Because the credit side is higher. When the account have nil balance, when both the side were equal, so total of debit side equals total of credit side, the accounts will have nil balance account. Is it clear to all of you? I believe it must be clear to all of you. Now we'll see the type of account and nature of account. So assets. As I told you, the nature of asset is debit. So the nature of asset is debit. That means what? It is to be debited when it increase and it is to be credited when there is a decrease. So it is to be debited when there is an increase and it is to be credited when it is decrease. The nature of liabilities is credit. So we will write over here credit balance. All of you take notes along with me. In liabilities portion, because it is credit balance, so if there is a decrease in the liability, it is to be debited, and if there is an increase in the liabilities, it is to be credited. The liabilities and capital is having same nature, so the answer would be same. Incomes, generally the income balance is credit. So we will write credit balance in terms of income, the nature of balance. That means what? In case of increase in income, it is to be credited, and in case of decrease in income, it is to be debited. And at last, we'll see the expenses part. The nature of expenses is debit. That means what? In case of increase in the expense, it is to be debited. In case of decrease in the expense, it is to be credited. I believe all of you are clear with this. Let us move to the next topic, and that is traditional approach, that is golden rule of accounting. Number one, so this is a commonly method used of accounting. Basically, there are three types of accounts: personal, real, and nominal. We will learn over here when is to be debited and when these accounts needs to be credited. So the golden rule of accounting in respect of double entry systems are these three accounts. Let us begin. So the nature of account, if the nature of account is personal account, when it is to be debited. So debit the receiver. Receiver of what? Receiver of benefit. And when it is to be credited, so credit the giver. Credit the giver. Giver of what? Giver of benefit. The next is a real account, that is fixed assets or non-current assets, cash. Okay, so real account, the rule is debit what comes in, credit what goes out. Debit what comes in, credit what goes out. And the last is nominal account. Debit all expenses and losses, credit all incomes and gains. It is very crucial. So all of you must learn the golden rule of accounting. Kindly learn it. Personal account, real account, nominal account, and these golden rules. We are moving ahead with the common sense rule of accounting. What is the common sense of accounting? So generally what happens if there is an account which have a debit balance and you want to increase the account, in that case again you need to debit that account. I'll quote an example. Supposingly cash account is having a debit balance. Why? Because cash is an asset. All assets have debit balance. So cash account needs to be debited. So cash is an asset and that is why their nature is debit. Supposingly, you want to increase cash. You want to increase cash balance. In that case, what will do? You will again debit the cash account. So note down over here with me. If a debit balance account has to be increased, further debit that account, where you will write it. So write on left side of the account. I'll show you a sample. This is the T-shaped account. This is the left side, debit side. So you will need to write it over here. Let's see the next part. So if a debit balance if a debit balance account has to be decreased, in that case, what we need to do? All of you, think of it. What we need to do? Then credit that account. It's quite simple. We should credit that account. Where we will write? So write on right side of the account. So this is a T-shaped account. This is debit. This is credit. This is right hand side. We will write over here. Let's see the next part. If there is a credit balance and credit balance account has to be increased, what we will do? We will again credit it. If a credit balance account has to be increased, credit balance account like liabilities, further credit that account. How you will record in the books of accounts? Where you will show? On the right side of the account. So kindly write on right side of the account. This is a T-shaped account. This is credit balance. This is right hand side. And vice versa. If a credit balance account has to be decreased, in that case, what you will do? We will debit it. So we will debit that account and obviously we'll write on the left hand side. So write on left hand side of the account. Left hand side. This is a sample. All of you are done till here? Let's move to the next topic, and that is types of accounts. So basically the accounts are bifurcated into two types: personal account and impersonal account. We have personal account and we have impersonal account. Further, the impersonal accounts are bifurcated into two parts: real accounts and nominal accounts. And there are three types of personal accounts. The first is natural personal account. The first account is natural personal account. So all accounts which record transactions of natural human beings are known as natural personal accounts. Natural human beings as of Ram, Lakshman, Sita, Gita, Krishna, debtors, Kabir, Joseph, creditors, and anybody. Let's take a note of it. David, John, Priyanka, etc. What is artificial personal account? So artificial personal account is created by law. So it is created by law. So it is having a separate legal entity and a perpetual succession. So we should write over here they are having separate legal entity created by law. The examples are Aditya and Company, LK Industries, ABC Cooperative Society, etc. The third is a representative personal account. So over here, the representative personal account, they either represent a person. So how can they represent a person? The examples are capital account, like owner's account, because capital account is representing owners. We can write it as outstanding expenses account, outstanding expenses represent whom? Service provider. Or supplier. Outstanding rent. We can also write outstanding wages, etc. The next account is impersonal account, and in that account the first is real account. What is a real account? So generally what happens, all accounts which record transactions related to the assets of the company. if that asset is a non-current asset or a current asset. So these are known as real account. Kindly take the notings. All accounts which record the transactions relating to what? Relating to assets of the firm. Example, building, land, furniture, fixture, machinery, investments, cash, bank, etc. The next account is nominal account. What we record in nominal account? So we record incomes, expenses, profits and losses. Kindly take a note of it. So income will come from where? So write incomes, public gains. For example, sales, rent received, interest received, dividend received, commission received, profit, etc. Now write expenses and losses. Salaries paid, wages paid, rent paid, insurance, bad debt or depreciation. You can also write discount allowed, etc. So this was about types of accounts. We had discussed personal account. In personal accounts, there are three types: natural personal account, which is created by God; artificial personal account, which is created by law; and representative personal account, which is representing a person. Then we shifted to impersonal accounts. The first is real accounts, and another is nominal accounts, that is expenses and losses, incomes and gains. Let's move to our next topic, and that is determination of profits and losses. There are two approaches. So how profits and losses can be determined? Meaning of profits and losses and financial statement. So point number one, what is a profit and what is a loss? So profit means excess of income over expenses. Excess of income over expenses, that is profit. Losses refers to expenses over income. So it's quite simple. If I write over here profit equal to incomes minus expenses. And in case of loss, it is expenses minus incomes. Satisfied? The next is financial position. Financial position. So how come we can find a financial position of a company? By making balance sheet, which is also known as statement of financial position. So statement of financial position. By preparing statement of financial position, we can know the financial position of the business. What we will record in statement of financial position? We will record all assets and we will record all liabilities. So we will record all assets and we will record all liabilities. In liabilities, we have two parts. We have current liability, we have non-current liability, and we also have equity. In assets, we have current assets and we have non-current assets. So total assets minus total liabilities. We can write it as total assets minus total liabilities. I had included the equity part in liabilities only over here. Students, let's move to our next topic, and that is determination of profits and losses and financial position. So how the profits and losses needs to be determined? We have two methods over here. The first is accounting equation method and the another is traditional approach. So we'll try to calculate it through accounting equation method first. Accounting equation method. Determination of profits and losses. So how profits needs to be determined? What you can do, you can write step 1. Try to find out the difference between the closing capital and opening capital. So just write closing capital minus opening capital. The difference between closing capital and opening capital. And this will give you what? This will give you profit. Profit of the year. What you can do in step 2, you should understand one thing, that if this profit is positive, if the profit is positive or this amount, this balance is positive, if the difference is positive, greater than equal to 0. So if it is greater than 0, then it is obviously a profit. So if the difference is positive, it is termed as profit. It is termed as profit. And how you will calculate capital? How you will calculate capital? So capital equal to total assets minus total liabilities. Total assets minus total liabilities is known as capital. How you'll determine the financial position of the business? So obviously the financial position of the business is determined by making the balance sheet, that is the asset or liability. That is known as statement of financial position. So please write, a statement is prepared showing all assets and liabilities the total of assets and liabilities must be equal. Okay. Let's move ahead with our another approach, and that is traditional approach. So this is a very popular method. How we'll determine the profits and losses under this method? We will prepare two accounts. That is, the first account we will prepare is trading account, and another account we will prepare is profit and loss accounts. First account we will prepare is trading account, and another account we will prepare is profit and loss account. And by this we can try and calculate the profits. We'll try to compare. So those two accounts compare the incomes and expenses to ascertain the profit. Please write. Those two accounts compare the incomes and expenses to ascertain what? Ascertain the profits. How we will determine the financial position using a traditional approach? We will prepare balance sheet. So balance sheet is prepared. That's it. You can write the same answer. It is a statement showing assets and liabilities. All the assets and non-liabilities should be equal. So write, it is a statement showing all the assets and liabilities showing all the assets and liabilities the asset side and liability side of the balance sheet must be equal. For a sample, I'm showing it over here. So this side is known as asset side and this side is known as liability side. And the balances must tally automatically. Tally automatically. I believe you must have understood till here. Let's move to the next topic now. And that is journal. That is phases in the accounting process. This is a very traditional approach, but a lot of clarity will come if we'll do this. The following accounts book phases to be followed: the determination of profits and financial position. Profits, that means income statement. We will prepare income statement for profit, or it is known as profit and loss account. And financial position, we will prepare balance sheet, or it is also known as statement of financial position. Okay, just see it over here. Source document. While putting the journal entries, we need some source document like vouchers, we need bank receipt, and we need till rolls. We need checks. So these are the source document by which we can put the journal entries. So first stage is source document. Then books of original entry. What we will do in the books of original entry? We will write journal and subsidiary books. After preparation of journal and subsidiary books, we'll do ledger posting in ledger accounts or ledger books. In ledger accounts, we'll do ledger posting. Then we will prepare trail balance. And at last, what we will do? We will prepare final accounts. Final accounts is income statement and balance sheet. That is profit and loss account and balance sheet. It is also known as income statement. I believe all of you must have understood it over here. So if I talk about the first entry, that is journalizing, what you can write it over here. Journal is the initial accounts book. It's a primary accounts book. It's an initial account book in which the transactions are recorded. When it is recorded on their occurrence. As in when the transaction, there is an occurrence of the transaction, it is recorded in the journal book. Okay. The next is the ledger posting or ledger balancing. Please take a note of it. That based on this journal entry, accounts are prepared in the ledger. All the transactions are grouped together over here. Then we'll move to trail balance. So after posting it to ledger, just write it over here. After posting it to ledger, after posting the transactions to ledger, a statement is prepared that is called trial balance. A statement is prepared that is called trail balance. My dear students, trail balance will give you the arithmetical accuracy. It will give you what? For arithmetical accuracy. Arithmetical accuracy of the transactions. Okay, kindly jot it down till over here. And at last, these two accounts, that is profit and loss account and balance sheet, is prepared. So basically this is known as performance statement. The profit and loss account is known as performance statement. Balance sheet is known as position statement. Balance sheet is known as position statement. And the company also prepared cash flow statement to analyze the pattern of movement of cash in bank. I believe all of you must have understood till over here. Let's move ahead with our next topic, and that is journal. What is a journal? Try to understand the meaning of it. So journal is a book of primary entry. It's a first-hand original entry. It's a first-hand original entry. It is the initial accounts book in which the transactions are recorded on their occurrence. Entry is made in this book to show what account should be debited and which account should be credited. So I'll quote an example over here. Purchase of machinery. The entry is purchase of machinery for cash. Supposingly this example is there. What you have purchased? Machinery. Machinery is an asset. Asset is having debit balance, and so the journal entry would be machinery account will be debited. For 10,000, and you will pay what? Cash. So cash account will be credited for what? 10,000 rupees. So machinery account debited 10,000 to cash account 10,000. Just see it over here. There is a format of journal is given over here. Date, particulars, ledger folio, debit balance, and credit balance amount. So we had put in date over here. This is a particulars. Cash account debited to Ramesh account. This is a folio balance. Over here 10,000, 10,000. 10,000 to be debited and 10,000 should be credited. So these should be equal. These two 10,000s should be equal. That means what? The debit value should equals to the credit values, or debit column should always be equal to the credit columns. Narration, a short description of the journal entry. Narration is a short description of the journal entry or of the transaction took place. So over here, what is this transaction? Being cash received from Ramesh. Ramesh has paid us cash. So Ramesh must be a debtor. In that case, he had paid us cash. So we had credited the debtor over here. So being cash received from Ramesh. Let's move ahead and see the golden rule of accounting. If I talk about the personal account rule, it is debit the receiver, credit the giver. Debit the receiver, credit the giver. Debit the receiver of benefit and credit the giver of benefit. Personal account, I already told you. Artificial personal account, natural personal account, and representative personal accounts. Then we have real accounts. The rule is debit what comes in and credit what goes out. At last, the third account. The rule is debit all expenses and losses. Credit all incomes and gains. So students, we had completed this unit over here, chapter 2, unit 1. Let's do some classwork practice. We'll begin with the multiple choice question. Let's see whether we'll be able to make it or not. So the first question is, the rent paid to landlord is credited to. Rent paid to landlord is credited to. So what would be the entry to rent paid to landlord? A rent account would be debited and cash account will be credited. So the answer is C, cash account. Question number 2. In case of a debt becoming bad, the amount should be credited to what? In case the debt becoming bad, the debt has become bad now. So you will be crediting the amount to what? See, because it's a bad debt, you need to credit the account to trade receivable account. Let's move to the third question. The third question is, A Limited has a 35,000 account receivable from Mohan. On January 20, Mohan makes a partial payment of 21,000. So out of 35,000, Mohan had paid 21,000 to A Limited. The journal entry made on January 20 by A Limited to record this transaction includes what? So a credit to the accounts receivable account of 21,000. Why? Because out of 35 he had already paid 21. So we need to credit 21,000. We need to credit 21,000 because they had already paid it. Let's move to question number 4. Which financial statement represent the accounting equation assets equal to liabilities plus owner's equity? Income statement? No, because in income statement we record what? We record income and expenses. Statement of cash flows, we record cash. And balance sheet, yes, the answer would be C. Why? Because we record assets, we record liabilities, and we record equity. Let's move to question number 5 now. Which account is the odd one out? Office furniture and equipment, freehold land and building, and inventory of materials. See, office equipment and freehold, this is basically non-current assets. Inventory is current assets, so it is odd. The answer is C. Question number 6. The debt written off as bad is recovered subsequently. So you have recovered the debt subsequently. What you will do? So you will credit it to bad debt recovered account. You will credit this to bad debt recovered account. What would be the journal entries for this? Supposingly you had received it. So bank account debited or cash account debited, whatever will be the case. And over here, bad debt recovered. Okay. Let's see question number 7. In double entry system of bookkeeping, every business transactions affect what? Two accounts. In the beginning of the class, we had discussed debit side, credit side, one account, another account. And at last, question number 8. A sale of goods to Ram for cash should be debited to what? Sale of goods to Ram for cash should be debited to what? Cash account will be debited over here, and because sale of goods has happened, so over here sales account. So the answer is B, cash. I believe all of you must have understood till over here. Let's see two theoretical topics. The first question is, write a short note on classification of accounts. So you must have seen there are two methods. The first is accounting equation method and the another is the traditional account method. So you can write it as the classification of accounts has done to two broad categories. The classification of accounts is divided into two categories. The first category is accounting equation approach, and you have traditional approach. Accounting equation approach, as I told you, is also known as modern approach. In accounting equation approach, you will bifurcate into three categories. The first is assets, then you have liabilities, and then you have equity, that is capital. In traditional approach, you need to bifurcate into two broad categories: personal account and impersonal account. Personal account, you have a real account. Impersonal account, you have a real account and nominal account. And in personal account, you have three categories: natural person, you have artificial person, and at last you have a representative personal account. Representative personal account. I believe all of you must have understood this question, that is, write short note on classification of accounts. Let's move to the next question, and that talks about distinguish between real account and nominal account. What we record in terms of real accounts is, so real accounts is generally properties and assets of the business, properties and assets of the business. Example would be land and building, plant and machinery, furniture and fixture, plant and machineries, furniture and fixtures, motor vehicle, etc. So these are the real accounts. If I talk about, so basically these are the assets which are not for sale. Fixed assets are the assets which are not for sale. Fixed assets are the assets of the company, assets of the business. To be used and not for sale. Sale purpose. Let's see the nominal accounts now. What we record in nominal accounts is, we record incomes and gains, we record expenses and losses. So what kind of incomes is this, or what kind of gain is this? Profit made during the year, is an gain. Depreciation is an expense, so depreciation on machinery. Wages and salaries paid to staff members, etc. If you want, you can also write the golden rule of accounts of real account over here and nominal account over here. The golden rule of account of real account is debit what comes in, credit what goes out, and nominal account is debit all expenses and losses, credit all incomes and gains. If you want, you can put it over here. Let's move ahead and do some practical questions now. Just try and understand this. Show the classification of following accounts under traditional and accounting equation approach. So the first is rent outstanding, then we have closing inventory, sales, bank fixed deposits, cash, bad debt, capital, sales tax payable, trade receivable, depreciation, and drawings. Let's try to solve it. So rent outstanding. You should understand one thing, it's a representative personal account. So as per the traditional approach, this is personal and there is an outstanding rent. So it is a liability. So as per the modern approach, it is liability. Closing inventory. Inventory you can touch, feel, see. So it is real account. Over here, the inventory is an asset as per the accounting equation approach. If I talk about sales, credit all incomes and gains. So it is nominal account. Over here, as per the accounting approach, equation approach, sales is income, that is revenue or income. Bank fixed deposit. So over here, fixed deposit will work as an asset and fixed deposit is personal in nature. If I talk about cash, as per accounting equation approach, the cash is asset and as per the traditional approach, the cash is real account. If I talk about bad debt, it's nominal account. Why? Because it is an expense. So bad debt is an expense, or you can also write it's a temporary capital, or you can write it as expense. Let's write capital. It's very simple. Personal account. Owner's capital. Owner is a person, so personal account. And over here, as per the equation approach, it is capital. Sales tax payable. Personal account as per traditional approach. Representative personal account. Artificial personal account. Sales tax department is an artificial personal account. And over here, because you need to pay it, it's a liability for the business. Trade receivable, so it's an asset for the business and trade receivable is personal account as per the traditional approach. Depreciation, depreciation is an expense, nominal account, it is an expense, and over here you can write it's a temporary account. It needs to be closed by the end of the temporary or the temporary capital, and it is an expense. If I talk about drawings, personal account, owner's drawing, temporary capital, and it is drawing. Okay, I believe all of you must have understood till over here. Let's see this question number 2, that talks about past journal entries for the following transaction in the books of Gamma Brothers. What journal entries we should pass? The first transaction is employees had taken inventory worth 1 lakh. The cost price is 75,000 on the eve of Deepavali, and the same was deducted from their salaries in the subsequent month. So the employees had took this at 75,000 of inventory. The cost is 75,000. So we need to reduce the purchases. See the answer over here. Salaries is an expense. And in terms of salaries, what we had given? Inventory. So we will decrease the purchases. So the general balance of purchase is debit, but because we are giving it to the employees, so there is a reduction in inventory and we will credit it. The amount is 75,000. The second one, wages paid for erection of machinery 18,000. Quite simple. Wages paid for what? For machinery. So don't make any error of principle over here. The wages are used for machinery, so machinery account will be debited. The amount is 18,000 and you had paid what? Cash. So cash account will be credited. Third, income tax liability of proprietor 1,17,000 was paid out of petty cash. So income tax liability you had paid from the petty cash. That means what? This petty cash is treated as a drawing because they had used for personal purpose. Drawings account debit, the amount is 1,17,000 and petty cash expenses will be credited. Let's see the last one, the fourth one. Purchase of goods from Naveen of the list price 2 lakh. He allowed 10% trade discount. So 2 lakh and 10% trade discount. That means what? 2 lakh minus 10%. 10% is 20,000 trade discount. So we will record it at 1,80,000. We will ignore the trade discount over here. 5,000 cash discount was to be also allowed for quick payment. Okay, no problem. No problem, Naveen. But we will record it at for 1,80,000. So this purchase is from Naveen. Purchase account debit 1,80,000. Cash discount is 5%. So we will write discount received. We had received the discount of 5,000 and 1,75,000 will go to cash payment. As cash payment we will record it. Okay. So we have completed this chapter over here. We had completed this unit. So chapter 2, unit 1, that is journal entries. We are completing it over here. Thank you very much. Thank you.